All right, we are live. Okay, so welcome everyone. Thanks for joining us today. We are the Binance Academy content team, responsible for writing the articles and glossary pages on Binance Academy. So yeah, please check out our work later at Binance.vision if you didn't do yet. So since this is the first Binance Academy webinar, we will start with the basics, but please let us know what topics you'd like to see in the upcoming live streams. Today we'll cover the basics of cryptocurrencies, Candlestick Charts, and hardware wallets. And then we have a Q&A section to answer some of your questions. Yeah, so let's get started. Okay, so what is cryptocurrency? So for those who don't know, a cryptocurrency is basically a digital form of money. It's a digital key transferred from one person to another over the internet. And to simplify, we can say that cryptocurrencies are digital files. So we can store, send, and receive cryptocurrencies just like we do with regular computer files. And as the name suggests, cryptocurrencies are basically digital files protected by cryptography. And this is what makes them quite unique and different from other types of. So cryptography is one of the things that allow us to use cryptocurrencies as a digital form of money. Mainly because they can't be copied, destroyed, or created out of thin air. Cryptocurrencies cannot be created without following certain rules. So a digital file that can't be copied, destroyed, or created out of nothing can certainly be used as digital money. That's the idea of cryptocurrencies. So let's see how do they work. So let's imagine that Alice sends 1 Bitcoin to Bob. And in reality, there's a bit more than that to this process, but for the sake of, let's just imagine that Alice's balance is reduced while Bob's balance is increased. And for this transaction to be confirmed and validated, we need some kind of database or ledger that ensures everything is correct. In other words, for this to work properly on a large scale, we need a system that checks if everything's all right. And this system is what we call a blockchain. So blockchain technology is at the core of nearly all cryptocurrencies. It works as a distributed database or ledger, and as such, it keeps track of all transactions, balances, and pretty much everything that is happening in the network. But unlike conventional centralized database, blockchains are maintained by a peer-to-peer network of users. So you can see in this picture here, the illustration here, instead of having only one database, centralized database as most banks do, blockchain is replicated across thousands of different computers, thousands of different nodes, that's how we call them. So everyone that is participating in the network holds a copy of the database, which is the blockchain, and they make sure their copy in sync with the rest of the network. And if you have any kind of mistakes or malicious behavior or incorrect data in one of these database, one of these copies, then the network rejects this one, and that's why the decentralized network is foolproof. It's safe and it works very well. So yeah, blockchain is what keeps track of all balances and transactions in this peer-to-peer network, which means there's no central authority, there's no bank control cryptocurrencies, at least most of them, and especially Bitcoin. And on top of all that, the database, the blockchain, is protected by cryptography, as we mentioned, which brings security and data integrity. So why are cryptocurrencies useful? Why do they matter? There are many different ways of building a blockchain and creating a cryptocurrency. But if we stick as an example, we know that it is decentralized, borderless, and censorship resistant. This means that there is no central bank, government, or authority in charge. Bitcoin doesn't have a CEO. In other words, you can be your own bank. You can control and move your funds without the need for intermediaries. And cryptocurrencies provide new ways of transacting value across the internet, and they are faster and cheaper than traditional payment systems. And here you can see the difference between centralized and decentralized networks. And of course, cryptocurrencies are, as we mentioned, they are a digital form of money, and they are tradable assets, which means they can be easily traded in hundreds of different markets. And in this context, we have two main types of cryptocurrency users. We can say we have traders and investors. So traders are the ones that buy and sell to try and make profits in the short and mid-term, while investors are the ones that buy and hold for potential long-term profits. Of course, you don't need to pick one or the other. There are many people that do both. They have like separate portfolios for short and mid-term trading and another one for long-term investing. And of course, we have many more users in the cryptocurrency space that are not traders or investors. They can be like developers or just work in the blockchain industry in different fields without necessarily using cryptocurrency as a tradable asset. And okay, so this brings us to the technical analysis, or TA, of charting methods that aim to predict upcoming market movements. So traders and investors, they use technical analysis and indicators in an attempt to predict the markets and eventually make profits of those movements. And candlestick charts are one of the most basic methods for technical analysis, and is the topic we're gonna discuss in the next section. Okay, so that's all from my side. If you want to read more about cryptocurrencies and Bitcoin, make sure to check out our Academy. We included a QR code here that you can follow, or you can just go to Binance.vision and find the articles there.
All right, so hey everyone. Thank you for that intro to cryptocurrency. So talking about candlestick charts. So what is a candlestick chart? As you'd have guessed, it's a type of financial chart that graphically represents the price moves of an asset for a given time frame. Now, it's made up of candlesticks, each representing the same amount of time, and this can be virtually any period, from seconds to even years. So candlestick charts date back to the 17th century, actually. Their creation credited to a Japanese rice trader called Hama. His ideas were likely what provided the foundation for what's used today as the modern candlestick chart. And some of the fathers of modern technical analysis, such as Charles Dow, refined his ideas in the early 20th century. It can be used to analyze other types of data, but generally they're used in the financial markets. Okay, so what is a candlestick? This is what it looks like on the image. As you can see, you need 4 price points to create a candlestick. These 4 are the open, high, low, and close. You might also hear these values referred to as the OHLC values, as in open, high, low, and close. Open is the first recorded price, high is the highest, low is the lowest, and close is the last recorded price in the time frame that the candlestick represents. So the high, for example, if it's a 5-minute candlestick, then it's the highest price within that 5 minutes. If it's a weekly candlestick, then it's the highest price measured in that week, and so on and so on. So what determines how a candlestick looks? It's the relationship between these 4 values. Take a look at the candlestick on the left. We can see that the price opened, it went higher and lower, and eventually closed lower than the open. Now, there are additional things we need to learn here. So the distance between the open and the close is called the body of the candlestick. Little spikes you see between the body and the high and low are called the wicks. The range between the high and low is also called the range of the. Okay, so now we actually know all this, so let's move on to the green candlestick. The only difference is that the close is now higher than the open, so we know that in this case the price went to the high and the low, but eventually closed higher than the open within the time frame of the candlestick, of course. So now we understand what candlesticks are. Let's actually take a look at a candlestick chart. So this is what it looks like. Now we actually sort what we're looking at, right? So we can see that candlesticks can come in different shapes and sizes, and they can tell us many things about the market. This is actually the weekly chart of Bitcoin. So each candlestick represents a week of price action. And now we can read a bit better what's actually happening here. So I've also included these for comparison. So we're looking at the exact same data as the candlestick chart we just saw, but with a line chart and what is called a bar chart. So they all represent the same price action, but they tell a slightly different story. But it still might be worth looking at the same price structure with different chart settings just to maybe get a fresh outlook on the market. And now you're at least familiar with how these look. So, what do candlestick charts tell us? They show the battle between bulls and bears, trying to push the price up while bears are trying to push it down. So with that, the longer the body, the more intense the buying or selling pressure was during the measured period. We can see in this example that on the left side, volatility was quite low. The range of those candlesticks was fairly contained. And then the bulls have taken over the market, leading to increasingly long candlestick bodies that represent increasing buying pressure. And when the move topped, bears have taken over and selling pressure overpowered the buyers. And we've been able to determine all this just by glancing at this chart. So what are the limitations of candlestick charts? They do show you the high and low, but they don't tell you which one came first. So if you want to find that out, you need to zoom into a lower time frame and check how the events in price action unfolded. In addition, candlestick charts may contain a lot of market noise, especially on lower time frames. But of course, lower time frames are much less reliable than higher time frames when it comes to most types of analysis anyway. So far we have discussed what is referred to as the Japanese candlestick chart. But there are other ways to calculate candlesticks, and one of them is called the Heikin Ashi. It stands for average bar in Japanese, and it relies on a modified formula that uses average price data. The main goal is to smooth out price action, filter out market noise, and make it easier to spot trends and price patterns. So we're looking at the Heikin Ashi calculation of the same range that we saw earlier. And this one may be a bit more friendly and easier to read, but it also may react slower than a normal candlestick chart. So this can be an additional tool in your toolkit. Alright, that's it for candlestick charts. If you're interested in the topic, here are some additional articles on Binance Academy that cover candlestick patterns. And now you understand what candlestick charts are, so patterns are a logical next step to explore. But first, let's talk about hardware wallets.
How's it going, everyone? I'll be talking to you about hardware wallets and why they're important for securing your cryptocurrency. So let's first recap on private keys. A lot of you probably already know that these are vital in cryptocurrency. These are what make the cryptography kind of possible. It's what allows you to say that you have the right to spend certain funds. But all this is a number between 1 and 2 to the power of 256. So you would pick a number somewhere between that range. And you might be thinking, couldn't someone just guess my private key? But in reality, that upper bound, 2 to the power of 256, is close to the number of atoms in the universe. So that's like me picking a random atom in the universe and you then guessing that same atom. You could be guessing your whole life. Your children could be guessing their whole lives. Your grandchildren could be guessing their whole lives. And there's never find it. So long story short, it's a bit stronger than your mom's Netflix password, and it is like a password with two very important differences. The first is that it can't be recovered if you lose it, and the second is it can't be changed if someone learns about it. So the bottom line, as my favorite wizard likes to say, is keep it secret and keep it safe. Let's now look at how a transaction works. So what you do when you transact, or rather what your wallet will do, a lot of this is abstracted away, is it'll gather up information from the blockchain about the funds you're going to send. It'll put together a transaction saying something like, I would like to spend these funds to this public address, and then you would add a digital signature to it. Now, the digital signatures are very important. They are created from your private key, and so by creating this signature, you can prove that you have the right to spend the funds. So with your private key, you have a public key that's linked, which is what you share when you're trying to get funds. And so other nodes can compare the public key with the signature, and they can say with certainty that only the person with that private key could produce a signature. And so that'll make your transaction valid if you do have the right to spend those funds. Now, to actually create the signature, because we're dealing with a lot of fancy cryptography here, you would need some kind of device. If you use an exchange, you don't actually hold your private key. So if you want to go and withdraw your funds, you're actually just requesting that the exchange creates on your behalf to whatever address you give them. If you use a mobile wallet, your device will be doing the signing. But nowadays, wallets do all that behind the scenes. You probably don't even notice it's happening. Now, both these services are good, but they're connected to the internet, which exposes a very big attack surface. Cryptocurrency is very attractive to malicious actors because it's highly liquid. It's easy for them to sell. With a very little effort, you can sort of opt the funds or the source of the funds. And of course, once you make a transaction, you can't undo that transaction. So these are what we call hot wallets because they're online. And it doesn't really matter whether they're constantly online or whether they just come online every so often. They're both vulnerable to those same kinds of attacks. Now, a cold wallet, on the other hand, is one that never touches the internet. And if you know what you're doing with one of these, it's the most secure way of storing your private keys because the only way someone could access that is by actually physically getting their hands on the private key. So this is obviously a lot more secure because you're not dealing with that internet attack surface, but it's also the most cumbersome method, especially when you compare it to something like a mobile wallet where you can do dozens of transactions. Generally speaking, it's not always the case, but generally, the more secure the wallet, the less user-friendly it is to spend from. And this is a paper wallet. I don't know if you're familiar with these. People kind of stopped using them like 4 years ago. But to the right-hand side, you have a private key, which obviously you're meant to keep secret. On the left-hand side, you have your public address, which you get from your public key. So you hand that out to people. They can send, and you can keep receiving funds as long as you want, provided you've generated this paper wallet, on an offline computer, and you've done it properly. That's getting donations, payments, whatever. You run into a problem when you want to go and spend. Obviously, it's a slip of paper. It can't make the signatures. So you would then need to take your private key and import it into another medium. And if you're not careful, you're exposing your private key to whatever that new medium has. So if it's an online wallet, you negate all the effects of keeping your wallet offline. Now, so what many people opt for nowadays are hardware wallets. You might be familiar with these. You get some big ones like Trezor, Ledger, and there are manufacturers. And these wallets aim to strike a balance between usability and security. So they're very secure, but they're fairly easy to use. They're not the easiest wallets to use, but they're straightforward enough. And what they are very simplistic computers. And broadly speaking, this isn't the case for all of them. This is just the kind of model a lot will follow. They're made up of two parts. So one part communicates with computers. It will query the blockchain for the information. It'll pass transaction information into the second partition, aggregated from the rest of the wallet. And this segregated partition is where you keep your private keys. And it keeps them secure because there's very little you can pass back and forth that partition. The private keys will never leave the partition. You can only pass transaction information. So what you could do is compose. It hasn't been signed yet. You need to expose the public key for that. You would then pass your unsigned transaction through the device to the partition. You would do the sign-in operation, and then you would pass the signed transaction back out, and then it can be broadcast. So the analogy I like to use for this when I'm explaining it to people is that it's a bit like having an elf trapped inside a postbox. Now, this postbox has some magical properties. You can't break it open. Even you, as the owner of the private key, cannot open it. The elf in this case is our private key. As you can see, he's not coming out anytime soon. He's too big to fit through the very small gap in that postbox. To pass information into the postbox. So if you take an unsigned transaction, you pass it into him. It'd do some, black elf magic, cryptography, sign the transaction and pass it back out. Now, even if the street around this wall was populated with malicious actors with all sorts of power tools, they would have postbox. Of course, some hardware wallets do have certain vulnerabilities, so you should do your research into the ones you're interested in. But in theory, this postbox cannot be broken into. Your private keys will never leave, so no one can access them. So they sum it all up. Your hardware wallet should be regarded as a kind of vault where you keep all your cash, gold, whatever, bury it in your backyard or something. Whereas exchanges and software wallets should be what you use day-to-day activities like small payments, lending, trading, staking, that kind of thing. And it's highly advisable once you accumulate a certain amount of cryptocurrency that you should look into hardware wallets. For the price, there's really nothing that matches it in terms of security. So if you're interested in those, we have a whole bunch of reviews on Binance Academy. I'd recommend you check them out. Thank you very much.
All right, thank you. Okay, so now we can move to the Q&A section. Let's pick some of your questions. Yeah, and other than the questions, I would like to say that your feedback is very important to us. So please let us know what could be improved for the next ones and what topics you would like to see in the upcoming webinars. All right, so let's see what we have for the questions here. I saw someone asking about the online course. This is something we are still working on. It takes quite some time, but they are coming. So yeah, stay tuned.
So we actually have some questions from Twitter earlier, so we could go over some of those. So for example, Tia Garajan, I'm probably saying that wrong, sorry, but so they're asking on Twitter, what is the difference between staking and delegation? So in proof of stake, blocks are added to the blockchain through the process of staking. So stakers log their coin holdings to have the chance to validate transactions and add blocks to the blockchain. And when they are selected and they successfully add the block, they get a staking reward in return. Now, delegation is a bit different, so it works with another consensus mechanism called delegated proof of stake. Coin holders can delegate their coins, meaning they can vote with them for delegates who are then responsible for validating transactions and adding them to the blockchain. So the rewards delegates get are then distributed to the coin holders who voted for them, proportionate to their votes. And of course, the delegates also make a profit because they also need to incentivize. They also need to be incentivized to do all this. So that was one question. We also had more questions on Twitter. So Crypto Gizmo asked, does Binance Academy track how many people find out about crypto and blockchain through Binance? And do you have targets for how many people you can reach? Yes, we of course keep an eye on the number of users that come to our site because our main mission is to get as many people educated about crypto and blockchain as possible. So we'd like to reach as many people as possible, and we have a great opportunity to do that since this is such a small industry still, and we have a lot of room to grow as an industry. And so we have Analytical on Twitter. What do you think are the single most important things for a new 1 year in, 2+ year in trader to understand? So I'd say the most important thing is risk management. Trading is a game of probabilities, and even one bad trade can really set you back, even if you're making good progress. So protecting your downside and having a game plan for all possibilities is very important to succeed over the long term. And so actually we've just released an article on position sizing and how it can relate to managing risk properly. So you can maybe look into that. We also have other articles on how to manage financial risk, just generally about risk management and how to protect your capital. So, yeah.
On top of that, I would say that apart from, creating a solid strategy, you should also follow your trading plan, because lots of people, they actually make a good trading plan, but they fail to follow it after some time. So that's also something I would add to your answer.
We have a question here about, are hot wallets safe? The goal of the hardware wallet piece wasn't to alarm you. Hot wallets are generally safe enough, but they're not as safe as cold wallets. It all depends on your risk model, really. I wouldn't store tens of thousands of dollars worth of cryptocurrency in a hot wallet. So it really depends. Personally, though, this isn't a rule. I would only keep small amounts or funds that I was actively trading inside a hot wallet, or just stuff for day-to-day payments.
Yeah, and hot wallets, we have many different kinds of hot wallets and different teams and developers. Some of them can have like security issues, and we can also consider exchange wallets as a kind of hot wallets, of course. So it really depends on which company or team you are trusting our funds. But yeah, I agree with you. If it's a very big amount, you should probably go with a cold wallet alternative.
Okay, great. So we have another question from Yusuf. How to know entry and exit points when trading? So that's not an easy question to answer. So that really depends on your individual strategy and what type of analysis you're using. Again, we do have a bunch of technical analysis articles on the site, so you could look into that, but there's not really a uniform answer that exists for that type of question. So I would say a good idea is to look for something that you think you are good at and try to create a trading or investment strategy based on your advantages.
Yeah, I would also add that, of course, traders have different strategies and methods. We have a bunch of different TA tools, but before you actually find out which one works for you, you need some time of testing. And if you pick like Fibonacci, for example, or Ichimoku clouds, you should have enough practice to be able to, read the charts and kind of visualize ideal entry and exit points. It's also interesting to mention the idea of trailing stop losses, which means if you have a winning trade, you should be moving your stop losses up to make sure you lock part of the profits. And yeah, that's what we call a trailing stop loss. But yeah, it really depends on your strategy, your style. Like some traders are more aggressive, others are more conservative. So there's no unique answer for this question.
Yeah. So Vegan Life asks, what is the difference between Ethereum and Bitcoin and other cryptocurrency? Bitcoin and Ethereum are very both use a blockchain. The main difference is that Bitcoin is very minimalist in its approach. Obviously, it's an older cryptocurrency, but its approach is mostly based on security. So it limits the amount of possible vulnerability points. So it serves very well as money, for transferring and storing wealth, people would say, is its main use case. Ethereum, on the other hand, allows you to do a lot of stuff with smart contracts. So with Bitcoin transactions, you do have some kind of functionality you can implement, but on Ethereum, you can do stuff like launch tokens. You can basically load on top of Ethereum. So it's more like a distributed computer to run applications, whereas Bitcoin is more, more true to that cryptocurrency idea of just money. And then other cryptocurrencies, there's probably too many to say, but they will fall into either, kind of smart contract capable, designed for applications, or they could just be money with certain features, like added privacy for stuff like Zcash, Monero, or scalability with others. So it depends.
Yeah, and we do have smart contracts for Bitcoin, but they are kind of they're totally different from the Ethereum one, and you can't really build as much applications and tokens and everything that you can on Ethereum. You can't do that on Bitcoin, but you can do lots of things on the Ethereum network.
Okay, next question. Onyeka Okonkwo, which one gives more reward, staking reward or saving reward? So, yeah, you'd need to check the individual rates for staking and using Binance savings for individual coins. So just go to the Binance savings page or the staking page, and there you'll be able to find all this information.
I think it also relates to the amount of coins you hold, or not really. I'm not sure.
Oh yeah, for sure. I mean, both cases, it depends on the amount of your holdings, of course. So we have another question from Yusuf. Digital currency like eRMB and cryptocurrency, they are same or different? So not all digital currencies are cryptocurrencies. So what we could call cryptocurrencies have very particular properties. So they are, peer-to-peer, borderless, decentralized, permissionless, public. There's many different properties that we could, and digital currencies are basically digital versions of fiat money, so money that already exists. And so it's usually issued by a central bank and controlled by various entities. And it's probably also not censorship resistant, while cryptocurrency is. So they are quite different.
We've been asked, Onyeka, which one gives more rewards, staking rewards or saving rewards? You can't really, there's no one size fits all answer to that. You would need to look into your specific situation.
Yeah, we discussed this one already. Thank you.
Sorry, I completely missed that.
Is there any job in Binance? Yes, so we do have a careers page. So yeah, just go to Binance.com, look for the careers page and look for our openings, and then you may be able to find something that you could do. We usually have many openings these days, so it's looking good. So a question from James Can. When will spot layout be modular like futures? That's not for us to decide. We don't know. We just create content for Binance Academy, so we don't decide on Binance.com or the futures product.
So Belial is asking, I'm not sure if I said it correctly, but how do you test the safety of new altcoins in general? So that's a bit tricky, but one thing that you should consider is the size of the network. and also the degree of decentralization. So if you have like more users and more nodes, if it's a big decentralized system, it's in general it tends to be more secure because you don't have a single point of failure that hackers can try and attack. And of course, the code matters, and if you have the programming knowledge, you could also check their code and see if everything is solid. But yeah, we don't really have a simple answer to that. Each coin has its own roadmap and team, and unfortunately, we have lots of projects that promise a lot of things that don't bring much, but that's not something we can talk much about. But yeah, in general, I would say that the size of the network matters and how many people are mining or participating in the block validation process and how decentralized it is.
I would just add to that the bigger the network, the greater the incentive is for someone to attack it. So if it is a popular network and it hasn't been attacked yet, this isn't the rule. There are always exceptions. But if the network has a lot of value on it, people have a big incentive to attack it. So the longer the network has gone on, you could kind of use that as a rule of thumb for, how many vulnerabilities exist.
Yeah, but I mean, if it's a big network, if we have like lots of nodes, it's harder to attack because it requires more computer power, and that's why Bitcoin is thriving for 10 years. And of course, Bitcoin has like thousands of developers and looking at the code every day and searching for vulnerabilities, and it's pretty safe because it's big, it's old, and it's open source and decentralized. And unfortunately, that's not the case for all cryptocurrencies. But yeah, good point. So let me just ask Jaeger, does Bitcoin use encryption? That's a good question because it's a very common misconception. So most people think Bitcoin actually uses encryption because we are always talking about cryptography, but in fact, the Bitcoin blockchain does not use encryption at all. It uses other cryptographic techniques, such as digital signatures and hashing functions. But the digital signatures, some of them have encryption, but that's not the case for Bitcoin. And so yeah, we actually use encryption when you are using software like wallets. When you set up a password for your wallet, your web wallet or your desktop wallet, you do use encryption to encrypt the password in a file, but that's not directly connected to Bitcoin nor the Bitcoin blockchain. So the answer is no, Bitcoin does not use encryption.
I think we missed an earlier question there about currencies interchangeable, specifically currency types like Bitcoin, Litecoin, etc. If you mean are they cross-compatible, can you move to the Bitcoin blockchain? No. You can do stuff like atomic swaps where you can trustlessly exchange coins of a certain type. I'm not very well versed in the specifics of these protocols, but there are protocols that aim to make certain blockchains compatible with each other. But I think chiefly what that does is it just allows you to move assets from one to the other, but you will be dealing with two different asset types depending on what the blockchains are.
Yeah, and we do have an article about atomic swaps, so if you didn't read it yet, you can check it out. It'll give you like the basic idea of how it works. So you can't really move Litecoin to Bitcoin blockchain, but you can use atomic swaps to exchange them in a very interesting way. And it brings a lot of interoperability. So it makes it easier to swap coins.
Yeah, and I think something that's worth adding here is that at this point, the atomic swaps are kind of a risky technology to use because there's many different blockchain projects that are working on interoperability within the space, but I mean, they are at early stages in development, so there's there's a higher risk when you're using them.
That's a good question by Yusuf. What are the top 5 skills to learn and eventually earn in cryptocurrency since the concept is relatively new? Like there's no easy get rich quick answer. The best you can do is read, study. You really need to research the projects you're interested in, and then of course you have different ways of earning. We do have an article on passive income, which goes into detail about the different ways you can earn: mining, staking, lending, trading, that kind of thing. So I'd advise you check that out. But the best advice you can take to start earning is just to read everything you can and understand the different projects.
Yeah, I would say that apart from that, you can it's a relatively new industry. So if you have interest in programming, blockchain programming, something that is, yeah, it's really good right now, and it's a kind of job that is on demand. But you can also work in other areas like creating content, marketing, or community management. We have lots of jobs around in the blockchain industry, and it's growing quite fast. But yeah, studying and learning and improving your areas of interest in a daily basis is my suggestion.
Okay, so we have more questions. With so many different cryptocurrencies, how will this work on the retail level, buying essential services, etc.? So currently, probably one of the biggest issues with this is that most retail service providers do not accept crypto. So there is a Binance card, for example, and so usually with these cards, what happens is that you have crypto on the card, and then when you're actually buying something, that crypto is getting converted to fiat. And so really the bottleneck here isn't necessarily the crypto system, but more the fiat system, because most retailers are not interested in taking crypto at this point.
So Onyeka asked, when trading an altcoins pair like XRP against BTC, it will be minus 5%, while XRP against USDT will be plus 25%. And so the thing here that you should keep in mind is that these are two different markets for XRP. In one market, you are trading XRP against Bitcoin, which means you can buy XRP using your Bitcoin or sell XRP for Bitcoin, of course. And then you have XRP USDT in a different market. So both markets have XRP as one of the pairs, but they don't always move together, because you can think of it as the flow of the money somehow. So if we have a lot of money coming from USDT to XRP, the second market would have an increase. But if we have a lot of Bitcoin being traded for XRP, then it's the first one. So they are separate markets with the same base pair. And of course, if you have like a stable XRP BTC price, but the Bitcoin price against dollar goes up, then the XRP USDT will also go up, because we don't have much trading activity between XRP and Bitcoin, but we do have Bitcoin price going up, and everything that is traded against dollar would eventually go up as well. And one of the reasons for this is because financial markets are highly, how can I say, we have lots of trading bots and trading activity that is automated. So some people, they create like programs that follow these changes in price, which means that if Bitcoin price is going up, other USDT pairs will probably follow right after. But yeah, they are two different markets.
So one thing I'd like to add here is, which also relates to a comment by James earlier. He said volume always drops in alts when there is a rally in Bitcoin. So look at Bitcoin as kind of an index for the cryptocurrency market. Like, for example, when you hear about the traditional markets, it's often looked at from the standpoint of the S&P 500, which is an index of the US market. And so when they're talking about the health of the US market, they're talking about the S&P 500. And so this is kind of similar with Bitcoin and the cryptocurrency space. So when the index is performing well, then that's where the attention is and that's where the money flows. And so even if, like, let's say the XRP, the value of XRP is going up in USDT, it might be going down against the index. So, for example, the way funds in the traditional market measure their measure their performance, is they measure their performance against the S&P 500. So they're not measuring it whether they are up in USD value necessarily. They are measuring it in relation to the S&P 500. So when you're actually trading BTC pairs, what you need to do is you need to find altcoins that outperform Bitcoin from time to time, which means that you're outperforming the index in that sense.
Yeah, it's all about money flow, I would say. It's like when you choose a pair, like a market pair, you are actually choosing the reference point. So if you're looking in Bitcoin against dollar, you are using dollar as a reference. But if you're trading against Bitcoin, you're using Bitcoin as a reference. And I personally think you should look at both because it gives you a better idea of where the money is flowing. And we can always, you can also think about the money going out, coming from outside of crypto to crypto and moving around crypto, like without leaving the space. So imagine from dollars to Bitcoin and from Bitcoin to altcoins. It's like two different kinds of moves. So yeah.
Ray asks, what programming language is the most popular? If you mean for blockchain programming, I'm not sure on the exact figures, but Solidity, which is used in Ethereum, and a couple others, is probably the most popular that I know of. But generally, you'd probably also want, legacy programming language to kind of hook up your Ethereum applications with, stuff like web pages or apps.
I know that Bitcoin uses a lot of C++, but they do have other languages as well. It's not only one.
Yeah, it depends what layer you want to work on. If you want to work on, the protocol itself, you would probably need something like C++. Or one of the older languages. If you want to develop applications, a lot of blockchains will have their own, language on the next level for developers.
You can actually check that on github.com/Bitcoin again. You can see like it's around 68% C++, 17% Python, and a few others. But yeah, it depends on your use case, of course.
All right, Mr. Anjaney, if I create Trust Wallet, write down seed and delete wallet, is it safe like hardware wallet? So Trust Wallet is a software wallet, so it's not as safe as a hardware wallet because in a hardware wallet, your private keys never leave the device. But if you write down your seed and keep it in a safe place, then you should still be fine. I mean, software wallets are still suitable for wallets that you would want to use more frequently than hardware wallets. So Yusuf asks, do you recommend using bots when trading? We cannot recommend any advice. I mean, it's all up to your preferences. So if you think you're good with programming, you're good with automated strategies, then sure, why not? I mean, the only thing with trading bots is that it's kind of difficult to find good quality information on it because most people who are good with trading bots, or most firms more who are good with trading bots, they're not going to share their strategy freely on the internet, because if they would, then the strategy probably wouldn't work anymore. So it's kind of a difficult thing to get into if you don't know what you're doing.
Yeah, and it's quite a broad question because, there are like thousands of different ways of programming a trading bot, and there are trading bots that hunt other trading bots. There are some people that use like artificial intelligence and machine learning. So it's a pretty complex field. And we also have lots of companies offering like ready to use trading bots, but I would say they are quite risky, mainly because of what we just said. Like if it's being like sold and provided to many people, it's probably not as good as it seems, because the good ones are being kept secret.
So we have Pradeep asking a great question. As we all know, less than 1% of the population use or know about cryptocurrencies. Those who haven't still feel this tech very alien and technically steep to learn. So how are you guys planning to educate, engage the remaining 99% and make it interesting for them? Yes, that is a difficult question, and that is what we're trying to do. So that's why we're trying to do different types of content, and we're always trying to get new users into the ecosystem and try to educate people about why cryptocurrencies are important, why they can be useful for them, and yes, why they should, why it matters for them. So that's what we're trying to do, and we're doing it step by step. So mainstream adoption is probably still a lot of steps from this point, but we'll get there.
Yeah, you can help the mission by spamming your no-coiner friends with all of our links. So feel free to do that.
Of course, that's always welcome.
You can also send us some feedback or ideas if you have. And we also have like a community submission program. So if you are a good writer and you have knowledge on crypto, you can always submit content to Binance Academy, and we'll be happy to check it out. And if it's good, we'll publish on our website.
Okay.
So Lin Yo is asking, can dApps be built on Bitcoin blockchain? And yeah, I think it cannot, because it's not like Ethereum. So Ethereum is like a decentralized computer platform that you can write code and build dApps on top of it. But Bitcoin is mainly created for the value transfer purpose. So it doesn't really allow you to create dApps on top of it.
Yeah. Belial actually answered using RSK, which is a protocol that kind of runs alongside Bitcoin. So building on the main Bitcoin blockchain, not really. A lot of the functionality has been kind of cut out. But there are kind of like side chains where you can build stuff. It's not pure Bitcoin, but it allows you to kind of interact with the Bitcoin blockchain.
When they say not your key, not your coin, what is key referring to? So key in this case is the private key that gives you access to your funds. So you can think of it as the password for your wallet or your vault. So your private key is what you use to sign a transaction. It's like you are if you want to use your funds, you need to sign a transaction and send the funds to someone else. So you need the key to do that, the private key. And if you're holding your coins on, for example, in cryptocurrency exchange wallet, you don't have your keys because your coins are inside the exchange platform, let's say. So if you don't have your keys, the coins are not really in your hand. You only have your coins for real if you are holding the keys, which means moving your funds from the exchange to your personal wallet, for example, your cold wallet or your desktop wallet, and then you would have access to your keys.
We missed an interesting question there from Vegan Life. When Bitcoin reaches its cap of 21 million, then what? What happens to its value, and how can you spend it or cash out? And this question actually bothers a lot of people, because yes, the Bitcoin reward will eventually run out. So as you probably know, there's a halving coming up, which will cut the reward to 6.25. But anytime a halving happens, it only cuts the current value in half. So the Bitcoin reward won't dry up until, I think it's the year 2140. But within the block, you also get transaction fees as part of the reward. So what people hope will happen is that the transaction fees will kind of make up for the missing Bitcoin. So the system should still keep working. But a lot of it's very hypothetical. Will Bitcoin even live to be 100 plus years old? So we don't know. The best case scenario is that the transaction fees continue to provide that security from mining.
And I would add that Bitcoin will probably become less accessible because we won't have new coins being generated. So it's kind of hard to tell. We don't really know what's going to happen, but if we don't have new coins being generated, we could say that it gets more scarce and potentially more valuable as well. But anyways, if you don't have any Bitcoin after the cap is reached, you would only be able to buy it from someone that already has, and that's how you would be able to access it and spend it. But if you already had Bitcoin, when the cap is reached, you can use it normally as you would. And yeah, that there's the fee, transaction fees, as we just mentioned. It's also something to consider.
Okay, so James asks, do you create content for Binance Academy? Yes, we're the content team on Binance Academy. So we're writing the articles and the glossary items and making videos and working on the upcoming course.
Estimated time when Bitcoin number reaches 21 million. That's
2140, I think, is when the block reward is seized.
Yeah, so we'll probably be long gone, but maybe our grandkids will see it.
Yeah, but that's depends on the ratio of blocks mined, right? It's not a set in stone.
Oh yeah. It can vary, sure.
Yeah. So I see someone is asking about the futures trading platform. I'm not really sure what you mean by selling half when futures leverage position, but I would just like to recommend the Binance Futures guide. So you'll probably get some good insights from the guide we have on Binance Academy.
Vegan Life, what is a smart contract? That is a piece of self-executing code. So these would be built on blockchains. No one really, people can own them, but with them you can launch code that no one owns, and you can interact with it by sending tokens or cryptocurrency to it. And once it receives that input, it'll perform some kind of calculation application, and then produce the output that you want.
So we actually have an article about smart contracts as well, but also if you just type in what is Ethereum, that also explains that concept in more detail.
So Lin Yeo asks, interesting one here. Besides halving, can Bitcoin be burned to create scarcity? It can be burned, and I would add to that lots of Bitcoins got lost along the way. So it's like Bitcoin is up for 10 years, and lots of wallets are lost forever, either because the owners lost their private keys, or they're not among us anymore. So we have thousands of Bitcoins that will never be touched, and you could consider them kind of like burned. And I believe we do have a function that can burn Bitcoins. We have some cryptocurrencies that actually use interesting consensus algorithm that is called proof of burn, in which you actually need to burn coins in order to validate blocks. That's not the case for Bitcoin, but it's something interesting. We do have an article about that. It's called Proof of Burn Explain. So yeah.
Yeah, I mean, technically, if you send your Bitcoin to the wrong address, just a random number, there's a good chance that that Bitcoin will never be recovered. So you do kind of burn the supply by doing stuff like that. But as we said, there's no built-in function as with some other cryptocurrencies. Is Satoshi's coin? Sorry, go ahead there.
Yeah, is Satoshi's coin considered burned? I personally think they are, because these coins are untouched for years, and it's a lot of coins. So who knows?
I mean, some people claim to have access to them, but until we're proven otherwise, no.
Okay, so Yusuf asked how many proofs are there, proof of stake, proof of work. So basically the question is how many consensus mechanisms are out there that allow blockchains to reach consensus in a decentralized way, and or not so decentralized way in some cases. And the answer is, well, there's many. I mean, there isn't really... So we know that proof of work works pretty well so far with Bitcoin. It had maintained the security of the network for the last 10 years. And there are many different implementations of consensus algorithms out there that different projects are experimenting. So, there could be potentially many different blockchain and cryptocurrency networks in the future that could use different types of consensus mechanisms.
What if Bitcoin developers stop development? Will BTC die? Not immediately. I mean, there's some stuff that needs to be patched before a certain time in the far future, just because of the way Bitcoin works. They weren't anticipated from the get-go. But the system should continue functioning. But obviously there would be a sort of a limit on how long it could go on without being patched. But anyone could study the code, anyone could figure it out. So so long as someone writes the code to fix it, and then other people accept that code, then it should be okay. If the world runs out of developers, then we have a problem.
Yeah, honestly, I don't think it's gonna die. Not because of that, at least, because we have thousands of people interested in this. It's a very unique project. We have thousands of developers joining every day, and I would say we have like the best developers working on Bitcoin, mainly because it's a very unique project and it has lots of potential to change the way we do finance and transfer value worldwide. So it's pretty interesting to see what comes next. Then Clark is asking, how do mining pools work? So mining is the miners, they are responsible for gathering unconfirmed pending transactions and validating them if everything is correct. They validate the transactions and add them into blocks. But this process is very resource intensive. It requires a lot of computer power and electricity and investments, which means it's not something everyone can do. And there's a lot of competition because the rewards for doing that are quite high. And that's why miners get together to create mining pools. And Mining pools are basically a collective of miners working together and sharing the rewards for their efforts, because the chances of them fighting a valid block alone are really low. But when they are working together and every miner is contributing to the process with their computer power, then they get better chances of finding a valid block, and then they can share the rewards accordingly. And that's how mining pools works, basically. We do have an article about that, so you can find on Binance Academy. Mining pools explained, the title.
This is a good one. Can cryptocurrency replace fiat currency? And if so, can you give us a practical example of how the system will probably work? You know, a lot of us are in the space because we think that the day will come where cryptocurrency does replace fiat currency. But you know, I think some of the biggest problems are adoption. You know, at the moment, even though cryptocurrency is a growing industry, it's still only got a very small user base. So the first problem would be to get everyone involved. Then we don't know if there would be a global currency or if there would just be hundreds of cryptocurrencies being used. A big problem nowadays is also scalability with some of the bigger cryptocurrencies. You know, how do you make it so that you have millions of transactions that can happen in a second? So there's a bunch of different kind of solutions being proposed. We have a couple articles up on Binance Academy about some of those. But that's just obviously it's a very subjective question you've asked. So let's hear it from the others.
Okay, we have another good question, but the developers don't get paid. So how do they manage expenses? So this has been kind of a big problem of the open source community for quite a while now, is that many people are interested and willing to work on open source software projects, but there isn't really a good way to finance them without having to go to the more traditional corporate structure of organizing people in such a way. But an interesting thing that blockchains make possible is organizations called decentralized autonomous organizations, or DAOs, and they can basically work autonomously and distribute funds and allocate funds to whatever the community that's running the organization wants to allocate them to. And so this could be a potential solution for long and sustainable fund source projects in the future.
Yeah, and many developers actually work as part-time on crypto and Bitcoin. I believe Satoshi was one of them, because we don't know who he is and we can't really be sure, but the records suggest that he was doing it as a part-time project, and eventually he got help from other developers and it started to grow very quick, and lots of people got interested in it. Okay, we'll take the last questions now. We are about to finish this webinar. Can quantum computers be a threat to Bitcoin in the future? Theoretically, yes, but that's not something we would see in the near future. I don't even know if we're gonna see it, because quantum computers, they are like a thing to do. So yeah, it's something that worries a lot of people, but we don't really have this as a real threat. It's just a theoretical thing, and you could theorize of quantum computers, but you can't really build one. And we do have an article about quantum computers and cryptocurrencies if you guys want to add a bit more.
I mean, quantum computing isn't just, it's not just a problem for cryptocurrencies. Bank security, every kind of security that you know today would probably be under threat. So you would need to upgrade the systems you use.
And we do have some quantum resistant cryptography projects being developed. And I do think that if this thread becomes real, like we would probably have some workarounds very fast, because there's just too much on stake here, and it's not something that will happen overnight anyway.
Okay, do you guys think we should wrap it up?
Yeah, I think we're over an hour already. If you want to take a last one. Oh, so how have you planned celebrating the upcoming halving? I know. We have a team on Binance that is working on a Binance halving celebration, and you'll probably see some kind of announcements in the Telegram chats. Unfortunately, I can't really give you the details right now because I don't have it, but I know they are preparing something, and we probably have some people. It would be like a presentation of sorts, and some people talking, and yeah, kind of like a podcast or something like that. You'll probably hear about it very soon.
Cool. I think that's us. Thank you very much for coming. We're very happy to be able to chat with you.
Yeah, if you move to the next slide, you have the QR codes for our Telegram groups. So yeah, feel free to join us. Leave more questions there. We'll be doing our best to answer your questions. Thank you for joining us today, and we'll see you in the next one.
All right, see you guys.